I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show and Happy New Year, Hilliard.
Nice to be with you again in 2018.
Canada has set a record for housing starts, but are we building enough homes to meet the projected need in the new year?
Well, there's several ways of looking at that, and all of them point to the likelihood that we are building more than enough homes across Canada, whether it be Vancouver or Toronto especially, but even Montreal and Calgary and Edmonton. There's a couple of ways to measure it. One is the amount of investment as a percentage of the total investment in society, and we're up at 8%. Which is way higher. It's about 33% higher than the peak that was reached in the U.S. before they had their crash. The other way to look at it is population growth, which has been 1 to 1.5% in Canada for quite a while, and that would imply about 150,000 new home starts needed, and we're well over 200,000 and have been for several years in a row. Another measure would be the number of people employed in the construction industry, which is at a record high right now, 14% of all workers employed in the construction industry. So all three of those indicators indicate that we're building more than enough. However, there seems to be shortages of the right kind of accommodation. For instance, rental, although they are starting to build more rentals, they haven't. If you go back a couple of years, they weren't, and they were building luxury condos, and a lot of those luxury condos in Vancouver, for example, sit empty because they're being used as a store of place to store money rather than a place to live. So it's possible that we're building too much of the wrong kind of accommodation and not enough of the right kind of accommodation. But these things tend to sort themselves out. Like those luxury condos, I don't know what they do if they end up if they have to rent them for $2,000 a month or $1,500 a month. It's when the condo can sell for, in the past was able to be sold for $1.5 million, but because whoever's bought that at $1.5 million, if all they're getting is $2,000 a month on it, they're losing a lot of money. Even just taxes and condo fees would be probably, never mind the lack of a return on the $1.5 million investment. But that's what happens when housing markets correct. And the trigger would be possibly a drying up of that foreign money coming in, whether it's here for investment or possibly fleeing another jurisdiction, or money laundering has been discovered in certain cases. So if that were to dry up, then we'd all of a sudden find out that there's probably enough housing.
Well, Vancouver also this year kicks in their 1% empty house tax.
Yes, that makes it tougher to sit as a store of value. Now, but the main thing that would affect that more than the 1% tax would be if prices stopped going up. And certainly condos have still been rising in value because people aren't buying single-family homes anymore. There's a large number of $3 to $5 million homes in West Van sitting empty with for sale signs on them, but the condo market apparently is pretty hot, and that's because probably the financing for those more expensive places has dried up. So, one of the things that I've done some research on lately is the debt levels in China, and the private sector debt level. It's mostly in corporations, not so much in household debt like it is in Canada, but in China it's mostly in the corporate sector, has quadrupled in 9 years, which is probably never happened anywhere on the surface of Earth, maybe even in the universe. Who knows? But certainly in Earth, it's never happened in a large economy ever in the past. A fourfold increase. And the question is, where did that money go? Well, I suspect a lot of it probably came in the form of real estate investment to other places like Los Angeles and San Francisco, and Vancouver at one time was third. Now it's fourth behind Seattle. So, and New York and Toronto and all kinds of places. And it's a way of getting money out. But it isn't necessarily cash. To us, it looks like cash, but at home it was probably, could very well have been borrowed money, which makes it very, very likely that at some point, if the government in China cracks down on that, either money leaving the country or possibly on those loans, then that source of money might dry up.
Well, one of the ways people are getting around the foreign buyer tax in Vancouver, 15% in the Lower Mainland around Vancouver, is a local person will buy a house, but the money is borrowed from a mortgage consortium in China, a large group of people who chipped in their $50,000 that can leave the country a year. They lend the money. The so-called buyer in Vancouver doesn't make any mortgage payments. They foreclose, and then they own that property and didn't have to pay the 15% tax.
Yeah, I've heard about that, and I know that's interesting that you describe it that way, because I've heard that from several places now, and one of the things that's a little bit hard to understand how that would work is there probably has to be a Canadian lender involved as well, and
there are no restrictions on foreign lenders, only foreign buyers.
Yeah, okay. So, but there's a big case that's been highlighted recently, just in the last few days, by one of the investigative reporters, and it's actually a civil case. It's not a criminal case. There's been very few referrals to FinTrack, which is the anti-money laundering group. But this is a civil case where two parties are disputing who owns what real estate. And but it's so embarrassing because obviously there were realtors involved, there were Canadian banks involved, and there's rules about suspicious transactions. And one of the triggers to be suspicious is, are there multiple parties unrelated, like not husband and wife, but just unrelated parties involved in transferring money in different ways. And when you read this court case, it's like, well, there's all of the triggers are being fired, and yet it appears that it wasn't referred to the anti-money laundering people. The only reason this is coming out is because it's in a civil court case. The two parties are disagreeing over who owns what. So it's so embarrassing, I think, that the next step will be that the authorities will start getting much tougher on this, because it's up to a 5-year prison sentence and some large amount of fines plus an administrative penalty to fail to report these things. And the people that are caught by it are financial institutions like where I work, lenders like banks and credit unions, realtors, notary publics. The one big glaring group that is not covered by this are the lawyers. They have an exemption because in Canada there was a court case that somebody argued that there was attorney-client privilege for lawyers, and they didn't have to reveal it. But even the lawyers, though, are supervised by the Law Society, and if the money's flowing through their trust account, then they could be caught in that case. And there was one lawyer in West Van that was caught. So only one lawyer so far was caught funneling some large amount of money through his trust account to make these transactions possible. I'm pretty sure that already various authorities will start being a lot tougher on these transactions, because that's a big part of what's making the real estate market so ridiculous. It's not just that. There's also local speculators. There's all kinds of things, but all of that's changing too, because the mortgage rules have been tightened. So it's going to be tougher for local speculators to do it as well. So it could be a double or triple whammy where local speculators are reined in, foreign money launderers are reined in, foreign investors are reined in, and the next thing you know, housing becomes affordable again.
But in the meantime, homeowners have lost all that equity as well.
Well, that's the problem. It is a shift. I mean, you have to. I guess the people that are the huge losers are the older people that have benefited from the gain in real estate who don't have any children. Right now, if somebody is older but has children, then it's sort of, if they care about their children, then they would say, well, I lost, but my children will find it easier to get into the housing market, so maybe it's a wash. But overall, when you do the economist mathematical thing and do the research, there's no actual wealth gained by having house prices rise. There's winners and losers, but it doesn't create any true wealth, not like a thriving technology industry or manufacturing industry or something like that. It doesn't create very many jobs, certainly not lasting jobs. And usually most of the increase in value ends up in the form of increased bank debt. So there's actually an additional interest charge that people are paying in society for the privilege of owning this expensive real estate. So in the end, it doesn't actually move any. The whole group doesn't move forward financially, but individually there are winners, obviously.
We'll have more with Hilliard Macbeth right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're chatting with Hilliard Macbeth. Hilliard, something that isn't talked about very much at all is the fact that while Canadians do have record household debt, according to home buying consultant Ross Kay, we are also paying off our mortgage debt at a record rate. Do people look at that number about what people are doing with their money and how they hope to get out of that mortgage debt sooner than later?
You know, there's one economist that keeps bringing that up, and it drives me crazy, because what he's actually talking about is it's only a small part of the picture. So because interest rates are so low, what happens is the amount of your mortgage payment that goes to principal is larger than it would be if interest rates were much higher. So if interest rates were 9%, you'd be paying more interest and less principal. If interest rates are 3%, then obviously it's different. However, having said that, if you got a 4% mortgage at 30 years, you're still paying about the same amount on interest as you did on the home. So you buy a $500,000 townhome, and you end up paying $1 million for that $500,000, including the interest. So that's what he's talking about. But it's not true in an overall basis, because mortgage debt has been growing at 5% per year or higher. It actually was a little bit higher than that until recently. For many, many years. So all of the people that have been paying their mortgage payments with more principal are lowering the amount of mortgage debt that they hold, but there's enough new people taking out new mortgages to make the total grow by 5% or even higher up until a couple of years ago. So we are there. That's a very misleading statement. It's true in a narrow way, but in the broad sense, the most important thing to remember is that collectively, all the households in Canada are going deeper into debt every year by a significant amount greater than the growth in the economy. So the numbers roughly are 4% more debt per year than there is GDP growth, which means, so now we're actually at 218% private sector growth, and now I'm including corporations and households, and than the GDP, more than double. So the GDP is roughly $2 trillion, and the household and corporate debt is over $4 trillion. So what that means is, when that debt growth slows down, we're going to have a very severe recession, and there's no way around that, because what's been keeping the GDP going has been the growth in the debt, and most of it's been going, as everybody knows, most of it's going to buy more and more expensive real estate, trading back and forth at higher and higher prices.
It's been explained sometimes too, it's not so much that housing prices come down, but people change their goals, or they can buy more house for less money.
Yeah, I think that's right. I think I think that for the seller, it's not going to be fun, because obviously with that amount of debt, there's a lot of owners who could be sellers, flippers maybe, who desperately need a higher price. House flipping doesn't work even with flat prices, because you've got the buy and the sell and the transaction fees and the commissions and all that, and the lawyers and all that. But so it hurts. And then, of course, once prices start to weaken, and we're seeing that in some suburbs in Toronto, in Richmond and Markham, prices are down about 20% from the peak in April of last year. There's starting to be some people starting to feel the pain quite severely. So, I mean, if everybody had 30-40% equity in their home and nobody was desperate to sell, but of course that's not what happens when you've had a boom as long as we've had. You get people that are just scraping their way into that expensive property, and they desperately need prices to keep rising. And of course, a lot of the people that had lots of equity in their home got lured into, tempted or lured or advertised, succumbed to the sound of, you're richer than you think, you should take some of that equity out and go on a vacation or buy another property or something like that. So, or help your kids get housing. So it's a fully levered up society that we live in, and it's unfortunately not a fun thing when it goes the other way.
We'll have more with Hilliard Macbeth right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Hilliard Macbeth. Hilliard, reverse mortgages when house prices are coming down, what happens there?
Yeah, I think, generally now I'm not really up on reverse mortgages, but the little bit that I understand, I don't really actually even know anybody that has one. They only are willing to lend up to about half the value of the home. So generally there isn't a lot of pain right away, I don't think, in terms of the reverse mortgage. What I advise my clients to do is to get a line of credit before they retire, and because the fees are much smaller and you've got a lot more control than a reverse mortgage. Because generally the reverse mortgages, unfortunately, they have a history of kind of preying on the little people. I'm sure there's some really good reverse mortgage people out there that wouldn't do that, but it is. I was talking to a 92-year-old client yesterday, and she told me her friend, who's also this similar age, is totally out of money. She doesn't have, not my client. My client's doing really well. She's invested really well over the last 40 years, and she's in great shape. But what she did, my client did a few years ago, was sell her house and move into a rental seniors home. So she's got almost $1 million invested with me, and she's got a small pension, and she's in great shape. But her friend insists on staying in her home, and so she thinks what she's doing is she's got a line of credit, and she's drawing money every month against the value of that house because she's living beyond her means. And I it could be a big problem. I mean, I talked to bankruptcy trustees in Ontario, and they tell me that the number one category of people that are getting into trouble with their debts are seniors. And I said, why would that be? And they say, well, two reasons. One is this woman that I'm mentioning refuses to lower her lifestyle even though she's can't afford it. And the other one is getting involved with helping their children to buy real estate. So they co-sign mortgages or something. That's a really fast way to get into trouble. And so those are the things. But so that equity, one of the things that the bankruptcy people tell me is that equity in that home is a good thing, but it also can be dangerous because it makes you feel richer than you really are, and it allows you to continue your lifestyle to beyond what you can actually afford.
So those ads saying you're richer than you think could be pretty misleading for some people.
Well, it certainly was a very successful slogan for one of the banks for many years, and when house prices are rising, I guess it works if you don't go too aggressively against it. But do you remember in the U.S. just before the financial crisis, everybody was saying, well, or just after the financial crisis, I guess, everybody said, well, they were just using their houses as an ATM machine, and that's why they all, got into trouble. Well, are we doing the same thing in Canada? It certainly seems like maybe we are. We've got tremendously high real estate prices. The only other place really that's similar to us is Australia, with similar sort of situation where prices have tripled in a short period of time. And it makes us feel rich, but it's not income. And so if we borrow against it, and then that equity starts to disappear, it can be a very quick road to trouble with the debt. And the question is, what are the lenders going to do? And I think as long as people, if that day comes, or when that day comes, as long as people stay current on their payments, I don't think the lenders are going to get after them too aggressively, even if that extra equity is mostly gone. But if of course, they'll have to foreclose if people start missing the payments, unless there's some kind of government program that comes in to bail them out. But then, the people who didn't borrow and didn't get involved in this using your house as an ATM machine, they would feel cheated, because they would say, well, hey, I didn't take all those chances with all that withdrawing the money. Why should they get bailed out? Because I was the one that did the right thing, so I'm paying taxes to bail them out. And that's of course it's going to be a very difficult political fight if they end up having to do that.
Well, what about municipalities that treat your home as an ATM, boosting property tax rates way beyond what your wage hikes were?
Yeah, I don't know how much sympathy people are going to have, because they say, well, those people made all that money on that gain in the value of that house, and the renters don't get any of that. So, but certainly the homeowners are a much more powerful political bloc than the renters. But the renters actually get a really bad deal when you think about it, because they don't get any tax breaks like a homeowner does. They pay all of their rent out of after-tax dollars. The only way the renters win is if house prices start to fall, and then, of course, they win because they avoid losing any money off of the decline in the house price values. But tax-wise, the renters are disadvantaged. Now, there's probably lots of landlords that could dispute that, but because most landlords are actually not getting enough rent to cover their costs. But that's only because they paid so much for the properties that they bought.
It also depends why you bought a home in the first place. Is it a place to live, or is it an investment?
I saw that in the recently about the thing about we should return the idea of a house back to a place to live, rather than always thinking of it as a speculation or investment or whatever. And I think we're headed in that direction, but we got a ways to go yet. And I think, unfortunately, the trail between here and there involves some hard lessons for speculators. That the only way a lot of people will learn that lesson is to suffer losses. I mean, one of the clues that the housing bubble is unsustainable is that so many people believe that it can only go one way. It can only go up. It can't go down. And whenever whether it be Bitcoin or marijuana stocks or Vancouver condos, once people start thinking that way, sometimes, especially with real estate, it takes a long time, but eventually they'll have to learn the lesson that it can go the other way too. It's been so long since we had to learn that lesson. But I remember it distinctly in the .com stocks in 2000. The same exact attitude could only go up because the internet is going to change our world, which is true. The internet did change our world, but it didn't mean those .com stocks stayed as high as they were. They all came crashing, or most of them, pretty much all of them came crashing down to earth. And speculation in real estate will have the same end, unfortunately.
Hilliard, thank you so much for chatting with us.
Nice talking to you again.
My guest has been Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our popular YouTube channel is Talk Digital Network. Questions for the show or our guests can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.